They paid $1,000 extra in cash just to beat you to a house. They quietly bought entire suburbs while you were distracted by mortgage rates. They know you can never compete, and they're already winning. America's housing market isn't just broken. It's being taken apart, piece by piece, while nearly everyone thinks it's just high prices. What you're about to see is how the dream of buying a home in America has been hijacked. And by the time you're done watching, you'll realize the collapse didn't start yesterday. It started years ago, and it's already far further along than most realize. In this video, we'll expose the secret infrastructure cracking under your feet, how policy, corporate money, data, and demographics are combining to turn home ownership into a relic. First, we'll go inside the silent takeover of neighborhoods. Then, we'll peel back how hidden taxes and artificial scarcity are strangling new supply. After that, we'll get to the final collapse triggers, the specter of adjustable rate resets, foreclosures, and the massive inventory lurking beneath the surface. By the end, you'll see this isn't a housing crash, it's a structural demolition. Let's begin. You've probably heard institutional buyers own homes. But did you know they now own 1 in 6 single-family homes? In places like Orlando, Atlanta, and Phoenix, that ratio can rise to 1 in 4. And these aren't landlords with a few rentals. These are Wall Street giants, BlackRock, Vanguard, Invitation Homes, backed by billions in capital, bidding 20 to 30% above asking price in all cash offers. Look closer. Internal memos from Pretium Partners lay out plans to control 300,000 single-family homes in 5 years. They don't intend to flip them. Their goal: turn neighborhoods into permanent rental portfolios. In Jacksonville today, institutional buyers control 43% of all single-family rentals. In Memphis, it's 38%. What that means is simpler than you think. Home ownership as we knew it is being converted into subscription housing. Normal buyers are shut out before they ever get their first bid accepted, and these firms use algorithms, instant evaluation, millisecond bids, crowding out humans completely. Now, this forces us to ask, if corporate entities now control supply, who truly sets the market? But that's just the first crack. Institutional investors now own roughly 3.8% of single-family homes nationally, homes they own and rent out, about 574,000 homes out of 15.1 million SFR, single-family rental homes. That may sound small, but in certain metros, the share is vastly higher: 25% in Atlanta, 21% in Jacksonville, 18% in Charlotte, 15% in Tampa. In Mecklenburg County, North Carolina, institutional buyers picked up nearly 7% of all single-family homes sold between 2011 and 2021, and they disproportionately targeted neighborhoods with above-average Black populations. This movement began after the 2008 crash. During the Great Recession, institutional players bulk purchased foreclosed homes in droves, turning foreclosures into rental portfolios. From 2011 onward, these firms remapped themselves. Houses that would have been owner-occupied were converted, often silently, into profit-generating rentals. That shift echoes what happened during the Great Depression, but with a twist. In the 1930s, thousands lost their homes, but ownership structures changed under public programs, like the New Deal's HOLC and FHA reforms, designed to preserve homeownership. Today, there is no sweeping agency stepping in to preserve ownership. Instead, we see a gradual transfer of ownership from individuals to institutions, almost by default without headlines. To get the scale, between 2020 and 2023, investors accounted for 18.5% of all home purchases. But by 2025, that share jumped past 26%. Some media reports claim, quote, investors now own 20% of the nation's single-family homes. In the next section, we'll see how taxes are forcing current owners to flee, making room for the takeover to deepen. You might assume once you own a home, you're safe. But not so fast. Since 2019, property taxes have increased by 109% nationwide, while home values only rose by 47%. In states like New Jersey, Connecticut, and Illinois, the average tax bill now exceeds $12,000 per year. That's $1,000 per month forever, even after the mortgage is paid off. In Texas, homeowners are seeing bills that exceed their original mortgage payments. A family in Austin making $85,000 per year, whose tax bill shot from $6,000 to $18,000 in 3 years. After mortgage plus taxes, they had less money in hand than when they were renting. This phenomenon has a name: tax force displacement. People who own their homes outright are forced to sell because they can't afford the carrying costs, and many are in the process of being squeezed out. Since 2019, property tax burdens across the US have ballooned. According to CoreLogic, tax payments have increased an average of 5.5% per year nationwide from 2023 to 2024, and overall up 27.4% since 2019. Meanwhile, Adam's 2024 U.S. property tax analysis shows that the average single-family home's tax bill rose to $4, a 5.8% increase over the prior year, even as effective tax rates slightly declined. What this means is simple but brutal. For many, the cost of holding onto a home is outpacing the value of owning it. Take Illinois. In Cook County's south and southwest suburbs, median homeowners saw tax bills surge nearly 20% in 2024, following reassessments that retroactively inflated home values. Or consider Chicago broadly. Between 2014 and 2023, the total property tax burden climbed 53.3%, rising from $5.1 billion to $7.8 billion, even after adjusting for inflation. These increases aren't just numbers. They translate into people being trapped, squeezed, and forced to exit. In places like Texas, property taxes have become so aggressive, they now exceed original mortgage payments in some cases. CoreLogic reports that since 2019, Texans' average tax bills have leapt by 7.1% annually, in a state where home values also surged, but incomes didn't keep pace. In Florida, homeowners are living the same nightmare. Their median tax amount in 2024 is around $3.100, up from much lower levels just 5 years ago. Yet the state's housing markets continue to be among the most competitive in the country. The result of this tax squeeze is what I call tax force displacement. Homeowners who already own their property outright often find that the carrying costs, taxes, insurance, assessments make it impossible to keep the home. They're not insolvent, they're trapped by policy. Here's the insidious part: many homeowners don't realize the problem until it's too late. Assessments are often blind or backward-looking. Property tax hikes can be hidden, gradual, and justified by local budgets or bond measures. Even when a homeowner protests, appeals are complex, time-consuming, and usually not successful. But this still isn't the worst. In the next section, we'll deal with how insurance, pulled away from many markets, is adding pressure on top of property taxes, pushing homeowners even closer to the edge. The question isn't whether people will be forced out, it's how fast. Imagine owning your home for decades. Then your insurer says, "We won't cover it anymore." That's happening now. Major insurers like State Farm, Allstate, and Farmers are pulling out of high-risk states: California, Florida, Louisiana. According to the Insurance Information Institute, 12.7 million homeowners now rely on residual government markets, paying 300 to 400% more than traditional policies. In Florida, the average premium is now $10, $996 per year, nearly $1,000 per month just for insurance. But that's not all. Insiders, internal models show that by 2027, 31 states will be considered uninsurable for climate risks, not just coastal states. Tornado belt, wildfire zones, floodplains. Nearly 67% of U.S. homes are at risk. In Louisiana last year, 47,000 homes were forcibly sold because owners couldn't maintain the required insurance. When insurance disappears, mortgages become void, banks can foreclose. Homes become liabilities, not assets. And that's precisely what the corporate buyers are banking on. In the past 5 years alone, private insurers have canceled nearly 2 million homeowners policies in response to rising climate risk. Many of these cancellations came with little warning, leaving owners scrambling for alternatives. In states like California, Florida, Texas, and Louisiana, insurers either pulled out entirely or stopped writing new policies. Let's break down what's going on. Nationwide, home insurance inflation is far outpacing general inflation. Between 2018 and 2022, premiums rose 8.7% faster than the Consumer Price Index, according to a U.S. Treasury analysis. In high climate risk zip codes, the gap is even more extreme. Homeowners in the most vulnerable areas pay premiums 82% higher than those in safer zones. One study estimates that 2 out of 3 U.S. homes are now underinsured against climate risk. In other words, even if you have coverage, it might not be enough when disaster strikes. Homeowners in high-risk areas see non-renewal rates that are about 80% higher than those in low-risk zones. That means insurers refuse to roll over your policy when it expires. In wildfire-prone Northern California, for example, some counties had the highest non-renewal rates in the U.S. over recent years. In fact, many insurers are no longer willing to take on new business in risky states. State Farm, for instance, stopped accepting new homeowner policies in California, citing wildfire losses, rising reinsurance costs, and construction inflation. Insured losses from natural disasters in the U.S. now routinely approach $100 billion per year, compared to the modest sums of 2 decades ago. Meanwhile, insurers are forced to raise prices or withdraw to maintain solvency. When insurers pay out more than they collect, they turn to reinsurance markets. Those reinsurance costs are skyrocketing, meaning insurers must raise premiums or retreat from exposure. But here's a twist. The areas most under stress tend to be the places many Americans want to live. Coastal zones, wildfire areas, river basins. As coverage unravels there, entire housing markets are at risk of collapse. And that's just one dimension of the collapse. The disappearance of insurance turns homes from safe assets into dangerous liabilities. Next, we'll see how demographic forces and the boomer sell-off amplify this insurance pressure, building into a cascading collapse no one can stop once it passes the tipping point. Baby boomers currently hold something like 38% of all American homes. That's tens of millions of properties sitting under the control of one generation. But over the next decade, many of them will hit the market, and that flood could drown values nationwide. Here's the calculus. Boomers have accumulated enormous equity. According to Realtor.com, boomers alone own roughly $18 minus $19 trillion in real estate equity. Another source places total U.S. home equity at $34.5 trillion, with boomers controlling half of it. That's a massive financial stake, one that's about to be cashed out. But the timing of that sell-off is critical. Because in many markets, the demand for large single-family homes is shrinking, and younger generations can't afford them. In regions of population decline, parts of Ohio, Pennsylvania, Michigan, older homes are already sitting for 180-plus days, with 25% price cuts in some cases. You may recall this from earlier sections about boomer sell-off pressure. The wave isn't theoretical, it's already forming. However, you need to understand a paradox. Most boomers are resisting selling. Recent surveys show that 61% of boomer homeowners say they never plan to sell their homes. Only about 10% expect to sell in the next 5 years. Why the resistance? Many cite aging in place, emotional attachment, fear of capital gains taxes, or the challenge of finding a replacement home. Yet just because someone says they won't sell doesn't mean the market won't force their hand. Health crises, rising maintenance costs, tax burdens, or needing liquidity for retirement or medical care all can push reluctant owners to unload. When millions of those reluctant owners face that pressure simultaneously, the market shock will be sharp. Consider this scenario. A boomer couple in Southern California owns a 5,000 square foot home, bought decades ago, now worth $4.5 million. A move would trigger nearly $700,000 in capital gains taxes under current law, so they delay the sale. Because the tax code hasn't adjusted in line with housing inflation, many boomers face monstrous tax bills for selling, so they stay put. That locks supply even as demand dries. Now imagine thousands of homeowners facing that choice in every major metro. Some will hold, many will cave. When they do, the equity they release will not trickle, it will cascade. In many smaller or shrinking markets, this cascade will be destructive. And here's the brutal part. Markets will be struck first where population growth is negative. Areas like the Rust Belt or rural counties with shrinking populations will receive the bulk of the boomer sell-off. Those markets already have weak demand. A surge of supply there will overwhelm any residual buyers, dragging values down 40% to 60%, as forecasters in prior sections projected. This shift is in motion already. In markets like Phoenix, Boise, and certain Sunbelt suburbs, investor purchases are up 100 to 200+%, even as first-time buyer purchases drop precipitously. Those investor purchases will compete directly with boomer sales, driving down prices for traditional families. The next section will examine how the reset of adjustable-rate mortgages and the corporate buying juggernaut converge to finish the job started by the boomer sell-off. Stay with me. Imagine signing a mortgage with a comfortable monthly payment, thinking you've locked in security, and then waking up years later to a bill that's $1,000 to $2,000 higher. That's the trap of adjustable-rate mortgages, ARMs, and it's about to explode on millions of unsuspecting homeowners. Most ARMs have a period of fixed interest, often 5, 7, or 10 years, before the rate begins adjusting upward based on a benchmark index plus a lender margin. After that fixed window, your rate usually resets annually, or every 6 months, according to prevailing market rates. Because ARMs are tied to market indices like SOFR, LIBOR, or its replacements, plus a margin, they rise when broader rates rise. Many homeowners assumed rates would stay stable or even drop. But in a rising rate environment, that gamble is turning into a catastrophe. Consumers took ARMs because they offered lower teaser rates initially, sometimes several points below the 30-year fixed equivalent. But that discount vanishes when the reset comes. Many homeowners now face payment shock, rate jumps of 2 to 3 percentage points or more overnight. According to an ICE/HousingWire analysis, 2.9 million ARM loans were active by March 2024, comprising 5.4% of all first lien mortgages. Of those, 831,000 ARM loans had already reset between March 2023 and March 2024. In many cases, borrowers saw their interest rates jump from about 5.64% to 7.55%, pushing monthly payments up $100 to $300 or more, depending on balances. Also, ICE reports that more than 70% of the reset ARMs experienced increases of 2 percentage points or more. Further data, 328,000 ARMs had already reset, and another 102,000 are expected to adjust in the next 12 months. These numbers are only for ARMs originated since 2019. Older ARMs likely have even more room to reset. Think about that. Hundreds of thousands of homes already baked in, and more on deck. Many borrowers were conditioned to expect refinancing or sale before reset, but in today's market, those options are often closed. During the lead-up to the 2008 crash, ARMs were a core piece of the collapse: teaser rates, negative amortization, exotic products. Today, ARMs are more regulated: full documentation, ability to repay rules, rate caps, and other safeguards. But those protections may not be enough given how far rates have strayed upward. Research from Real Estate Finance suggests that even a 1 percentage point increase at reset is associated with a 2.5% higher probability of foreclosure in the following year. Multiply that by 2 to 3 percentage point jumps, and you're looking at serious default risk. The system is also leveraged. Many ARM borrowers are younger, have less cushion, carry more debt, or are stretched to qualify under tight debt-to-income constraints. When thousands of ARMs reset into rates they can't support, foreclosures will follow. Many borrowers will default not because they were irresponsible, but because their payment jumped beyond capacity. Some will attempt strategic defaults, walking away even when they could pay because the value isn't there. Internal models from Fannie Mae and other agencies show that when home values drop 20%, strategic defaults spike 400%. We touched on that earlier. Banks are holding latent assets, homes in various foreclosure states not yet listed, waiting to release them. When defaults surge, these properties flood the market. That's a double shock: collapsing prices and swelling supply. Here's the brutal strategy. Institutional investors are waiting with cash. They know ARMs will fail. They expect foreclosures. They will scoop up distressed properties, often with cash. No competition from middle-class buyers who got priced out or foreclosed. Think of it like a game of chess. Corporate buyers control supply already. The tax squeeze forces exits. Insurance is failing. Boomers may flood. And now ARMs are the final push. The collapse becomes self-reinforcing. If just a fraction of those resets lead to default or forced sales, we could see millions of distressed homes hit the market within months. And once the dominoes start, tax sales, zoning, bank failures, shadow inventory, the momentum will feed itself. This isn't a slow leak. It's a crack widening into a chasm.